The top three option plays for the week, they aren't too flashy, they aren't too exciting, but I think they're going to print some decent money. So first off, we got WOOF, aka PetCo company, and what I'm seeing here is we've had some long time support at like 1787 here, 1780. You see every time it touches this area, it bounces up, it bounces up. It recently touched that again, went back up, back to this little volume peak here. So from here, I think we could sell some puts or some put spreads if you can get fills on that to make some easy money. Earnings isn't until March, so we don't have to worry about that. The thing I don't like about this is implied volatility is low, so it won't be too much premium, but I think it's going to be a decent amount anyway. What I'm looking at particularly is the February 18th, 1750. I think you could probably get a fill around the 45-cent mark. So $45 just to wait 47 days. So that's about $1 a day if you're able to be patient. And this only hold up like $250, maybe $300 in margin to have this position. It doesn't look like you'd be able to get some spreads on here, but if you could get a fill, $15 per $50 risk, or sorry, for 250 risk, not a huge return. I'd rather just sell a couple puts on whatever you feel comfortable taking assignment on and stick with that. So I'll be selling one, maybe two contracts of the 1750 February 28th put here. If you want to see the risk profile for this, basically I don't think this will get below 1780, so it's just going to be some free money to collect. Max profit should be about 35 to 45, whatever you get filled at. And then if it does get down here, take the stock and run the wheel on it. The next company I'm looking at is actually related, but we got Chewy. Again, Chewy been in a downtrend here, but it's going back up. It might test this little channel again, so in the short term, it might go up. And then if we get to like 65, it might start trending back down again. But what I'm looking at is, again, it was at an all-time low. It's going back up. I think we could sell some puts. Implied volatility, low, but, I mean, everything is pretty low right now, it looks like. If we go to the Analyze tab, again, February 18th, all three of these plays are going to be February 18th. I'm looking at either selling the 45 or the 50. The deltas are actually pretty low, so 18 delta for the 50, pretty safe in my books. But if you want to be even safer, 45, a 1% hold for 47 days is fine too. So one of these guys is what I'll probably be putting on. I'm probably leaning more towards the 50 here because I just don't think he's going to get back down to that 1 year low. But you never know. Stuff can happen. So $120 over 47 days. Or is that like $3 a day for it to burn on theta with one contract? And again, that's another play that won't take up much margin. It's going to take up like 300 margin in my account. So, pretty nice looking play for me. And then the last one I'm looking at is actually Microsoft. This trade I'm thinking about is actually like a broken iron condor. So, we've been trading in a range again in Microsoft. The volume profile shows that like 335 is like fair value. We're trading at that fair value again. I'm thinking if we sell a call above this high, sell a put below this low, and just let theta do its thing, we should be fine. Earnings is 216. All right. So I'm actually looking at selling the 360, which is above the peak that we've seen recently. And because I don't go naked to the upside, I always buy protection beyond that. So using some of that credit I receive from selling this call, I'm going to buy some protection. And I wrote down I was going to do the 385. So it's $84 for insurance in case I'm completely wrong to limit our max loss on this play. So we're selling one call, buying another, and then we're selling the 315 put. And if you look what happens, you got a decent P&L, where if it's between those two ranges, you make max profit, and then your max loss to the ups. Thinkorswim just crashed. 1 second. All right, so if it finishes between our short strike prices, we should get max profit, which if you look at this blue number here, should be about $771. So when we sell this, or when we put on this position, in Interactive Brokers, you'll be buying for negative $7.71. Other positions you might be selling for $7.71. So that would be the max profit we can make off this trade. If it goes above 360, our break even becomes 367, which is a decent movement from where the all-time high was in the last year here. And then if we go back, same thing to the downside. Like our break even is all the way down at 307 because we're receiving so much credit for this trade. It just makes our break evens pretty far, which is awesome. If it goes up to the upside and we're wrong completely and Microsoft just takes off, then the max loss we'll have to the upside is about $1,700. And then on the downside, I'll just take assignment of the stock and then sell cover calls against it. So those are my 3 plays. I'll more than likely put on the first 2, Microsoft. I'll see on Monday how I feel, although I think this is a pretty good trade setup as well. Something you may have noticed is that every play that I just said here, I told you what my backup plan is if I'm wrong. And that's just something that you should know is what your backup plan is and how to manage a trade that goes wrong. If you want to learn how I use some different methods to do that, you can watch this video on the left here. And hope you guys have a great week trading.